Hello and welcome. Thank you for joining us today for the launch of the International Energy Agency's new World Energy Investment 2026 report. This is the latest edition of our annual report, which is the global benchmark for tracking investments across the energy sector. I'm Jethro Mullen, head of the IEA's communications team. I'm joined today by IEA Executive Director, Dr. Fatih Birol, and by our Chief Energy Economist, Tim Gould, who oversaw the new investment report, which is freely available on the IEA website. So during today's event, Dr. Birol will make some opening remarks, and then Tim will present the key findings of the report. We'll then take questions from the journalists. For the journalists taking part in this event, we invite you to send your questions via the Q&A function in the Zoom. You can do this at any point during the presentation, and we'll also take a 2-minute break right after the presentation for you to enter your questions. With that, I'll hand over to our Executive Director, Dr. Birol.
Thank you very much, Jethro, and greetings to all of you, dear colleagues from International Energy Agency headquarters in Paris. This report, the World Energy Investment Report, we started to publish it 11 years ago. The reason is we thought it is important for the energy industry, governments, all stakeholders to know what is the budget of the global energy sector. Oil, gas, electricity, all the fuels we have, because before we started this, there were some great reports focusing on some of them on oil investments, some of the institutions prepare reports on electricity, but we thought it is important to provide the global budget of the energy sector. And in this report, we look at how much money is invested in the energy sector for oil, gas, coal, renewables, and everything, nuclear power, and which countries invested how much, and try to come up with some conclusions, recommendations, and observations. This is the 11th edition of this very report, going from strength to strength, thanks to my colleagues led by our Chief Energy Economist, Tim Gould. But this report, all of them were very important, but I believe this report is perhaps the most important one up to now. The reason is because, as I said a few times before, we are in the middle of the largest energy security threat in the history. We had several energy crises, 3 major ones, 73 oil, 79 oil, 2022 natural gas in Europe and beyond, but this is bigger than all of them put together. And I believe many governments, many countries are now reshaping their energy policies, reviewing their energy policies, and as a result, investment decisions and strategies are being calibrated or redirected in several countries. Why it is happening? Because Strait of Hormuz, a very important strait, is closed, which enabled about 20% of oil, gas flows around the world, in addition to other commodities, of course, and it is now closed. It has been always a question in the energy world, what would happen if the Hormuz is closed? But it was a theoretical issue, now it is real. And I would like to use a proverb here, which I have used a few times. By the Hormuz is closed, the vase is broken. And the actors in the market think now, if it is closed once, it may be closed again. So therefore, energy security, countries' national security, is now a key priority for many governments, many industry players. And in this context, I talk with many governments. We are at the IEA. We are discussing with the countries around the world and the industry players. We are seeing now on a daily basis that countries are reshaping their investment decisions. So it is the reason this report not only provides the budget of the global energy sector, and at this critical moment also provides data, information, knowledge for the governments and industry players. The budget is strong. The global energy investments, when I look at the numbers that my colleague Tim Gould provided me, the global energy investment as of this year comes 3.4, if I'm not wrong, Tim, 3.4 trillion US dollars. You put all the energy sector together, 3.4 trillion US dollars. But as I said, this report not only provides the breakdown, this 3.4 trillion US dollars by sector, by country, but provides very important, in my view, vital information for the governments how to reshape their energy investment decisions, strategies on the basis of right data and information. My colleague, Mr. Gould, will give you very important insights about our findings, but I thought, reading the report, I share with you, from my perspective, 4 key dimensions that the governments, industry players, citizens need to consider in the next years to come based on the findings of this very report and the global energy landscape today. What are those 4 dimensions that, in my view, determine maybe in the next few years our global energy debate? The first one is, when we look at the energy security, my golden rule number 1 for energy security is diversification. Not to have an over-reliance on one single country, one single trade route, one single technology, one single importer, over-reliance. And now, learning from the lessons of this Hormuz and the war in Middle East, many countries, both on the producers, exporter sides, but also on the consumer side, taking some steps in this direction. On the exporter side, on the producer side, the countries in Middle East that are going through very difficult times, most of the oil and gas in the region normally goes through Hormuz, but they are looking for alternative routes. For example, United Arab Emirates, they are fast-tracking building a pipeline, not through Hormuz, they're bringing the energy not through Hormuz, but through a different route through Fujairah, the other side of the country, to provide more security diversification. Again, some producing countries building stocks in the consuming countries, having some bilateral agreements there. Here, maybe I can cite a recent example, an agreement between the Indian government and the government of United Arab Emirates to have stocks of Emirates in India. Andy, leaving aside Middle East, going to other exporters, one recent example is the Canada. Canada adding new markets for their energy exports. Canada is now pushing a major pipeline to bring its energy to its future Asian and European clients. So these are some measures that we are seeing coming up as a response to the crisis and for the in the context of diversifying their energy systems. Also, some important countries are taking measures. Talking about Asia, for example, Japanese government is leading a major effort to provide the oil stocks safety net in among the Southeast Asian countries. So these are all coming through, and this is it is the today, if I am not wrong, Jetu, this is the third month that we are. It was 28th of February, I think. We have seen the war starting in the Middle East. We are seeing within this 3 months already some major action there. And we also see, dear colleagues, the prices are going up of many commodities, and in some commodities we are seeing some scarcity in some parts of the world, which is of course expected. But there is one commodity which is, in my view, the most scarce among all in the today's energy world, which is trust. I think we will all hear in the next months, years to come, trusted partners in the energy trade, in energy imports, or even exports. Countries, when they make long-term energy contracts, trade agreements, this can be LNG agreement, this can be building a nuclear power plant, they will not only look at how much this energy would cost, what is the technology, what is the quality of the fuel, but they will also look, can I trust this partner in the long term? This energy I buy, I sell, this technology I develop can be a risk for my energy security or national security. And I think trust will be an important element in the energy world in the next months and years to come. So these are some considerations on the first dimension, I thought, which will frame the global energy debate started led by the war in Middle East. The second dimension I would like to bring to your attention, reading the report of the World Energy Investment Report and looking around the world, I think there will be a growing preference of many countries to bring their markets energy as much as possible from their domestic sources. It is important everywhere, but especially I believe it is important and it is a major topic in Asia, where the bulk of the today challenge is, because Asia imports 80 to 90% of its oil and gas from the Strait of Hormuz from Middle East, and Asia is very important, as we all know, the engine of the global economic growth. So I think we will see many countries will give a second look at their domestic oil and gas resources, whether or not they can bring oil or gas to the markets, if it is geologically and economically if it makes sense. But I think we will see a stronger momentum, especially in Asia, but everywhere around the world, for renewables, solar, wind, geothermal, hydropower around the world, for nuclear power, and in some countries, coal as domestic energy resources. For solar, we are seeing since several years a very strong growth of solar, and our report tells us that today the solar investments are about $1 billion per day. Even though as a result of policy changes, we may see some volatility here and there, but solar is a major source of energy, which we think will get an additional boost from these concerns about energy security. And the recent data I saw in the report, the trade data, that there is an increase of imports of solar panels in Asia, in Africa, and elsewhere. In terms of coal, as I said, some countries, especially those in Asia, but not only, we may see coal investment coming up, and our report estimates that this year, 2026, coal supply investments may be the highest in the last 15 years, mainly driven by Asia. So, dear colleagues, when we talk about the domestic energy resources, talking about the coal, renewables, nuclear power, and others, some countries have these resources, some don't. But there is one energy resource all the countries have today, which is energy efficiency. The energy efficiency potential is there to be used, and we believe energy efficiency measures in many countries will be deployed in order to make the energy more secure and more affordable. When you look at the 1970s oil crisis, we have seen the car manufacturing made a major move to make the cars much more efficient, and refrigerators, for example, a typical refrigerator after the crisis used only 1/3 of the electricity it was using before the crisis. So we will see that type of energy efficiency measures in the many countries. In fact, International Energy Agency in the end of June organizing a major global energy efficiency conference in Canada to bring this experience to the attention of governments around the world. Dear colleagues, in addition to these issues on the diversification and preference for the domestic energy sources, there is a third dimension I want to bring to your attention, which is the electrification. We think electricity is going to make a even stronger inroads in the total energy mix as a response to this crisis. IEA has already highlighted that the age of electricity is coming, very strong growth, and now as a response to this crisis, we see countries are taking some additional steps to electrify their energy systems, especially the countries that rely on imported energy. One of them is France. President Macron recently announced a major electrification strategy for France, but not only. When we look at the South Asia, we see that several governments give support for buying electric cars in Vietnam, in Thailand, other countries where we see electric car sales are skyrocketing. I mentioned a few minutes ago that the total global energy investment, when we put everything together, is 3.4 trillion US dollars, and 60% of it goes to electricity-related projects. 60% of the entire energy investments. And when we look at our first investment report some 10 years ago, the share of electricity was less than 40%. So we see a major growth potential there. And of course, it is driven by, as I mentioned, electric mobility, but also artificial intelligence, which requires a lot of electricity. And we see in many countries, it is coming very strongly. The energy investment, electricity investment for data centers. United States is a major example here, and especially gas-fired power plants in the United States, but also coal. And another striking number coming from this or finding from this report is that for the first time in decades, United States, the fossil fuel power electricity investments overtakes this year that of China. So gas and coal power investment in the United States set to take over of China's investments here. Dear colleagues, with this, I would like to come to the fourth and the last dimension I want to bring to your attention is the following. Yes, in the investment domain, we are going to see a more and more focus on energy security. But this may well mean that in some cases, substantial amount of additional investment and additional cost. Who is going to pay the cost? Who is going to make those investments? And when we look at countries around the world, we see that the many countries' public budgets are strained, and with the high energy prices now, we may say inflation going up, and that it could have a significant implication for the interest rates, which in turn can make especially the expensive projects much more challenging. So this will be a major problem, financing, and in this context, we believe our report shows that the role of institutional investors may be bigger now than they are in the past. They are already playing an important role in some of the largest listed energy companies, these sovereign wealth funds, the asset managers, and others, but we may well see them playing a more important role than in the past, given the investment challenge we have, and their role in terms of the share in the energy investment financing may be bigger than before. To finish, dear colleagues, when I look at these four dimensions, I try to bring to attention that countries will try to diversify their energy mix, their energy partners, and they will try to generate electricity energy, I should say, as much as possible domestically. And they are going to try to finance it through from different challenges. And here, electricity will play a very important role. And they are not all going in the right direction, or the same direction, I should say. Not only they are not going in the same direction, and at the same time, given the very difficult international political landscape, governments need to make a lot of trade-offs in their decision-making system. And how to make the best trade-off in the benefit of the given country, given company. You need data, you need information, and here comes our World Energy Investment Report, which is ably led by our chief energy economist Tim Gould and his excellent team. Here, I would like to thank again to you, Tim, and to your team for this excellent work. And I pass the floor to you, please.
Well, thank you very much indeed, Executive Director. And you mentioned the team. They've really done a wonderful job here. But there was contributions from all the way across the agency for this work. And I'd like to also recognize the leadership on this of our Cecilia Tam, who's the head of our Energy Investment Unit. Going to talk through some of the findings now. And I want to start with in a sense, the biggest of the big pictures. This is our sense of how those energy investment flows are today, but also how they've evolved since 2015, which is when we started this World Energy Investment Series. Now, I could spend all day talking about this slide, but I just wanted to highlight, you can see that $3.4 trillion number that the Executive Director mentioned. That's our expectation for this year, and how it breaks down across the different categories that we track. And you can also see some of the themes that have been mentioned already that we developed in this report. You know, the rising role of renewables, the rising role of electrification. But I do want to dive straight in and touch upon what for us was the key theme of this year's report, and that's what might be the implications of the Middle East conflict for investment strategies. And to help answer that forward-looking question, we started by looking back at how energy investment responded to the energy crisis of 2022. It's different in many ways, but also involves substantial price spikes for fuels and affected energy importers quite strongly. And what we found really echoes the points that the Executive Director was making about that sense of going back to domestically available resources where you have them, and renewables are very widely spread around the world. There was also some upside for nuclear, for electrification, including the infrastructure, and for efficiency. And what we also saw in the most recent energy crisis was, particularly for some overall energy importers in Asia that have domestic coal, they invested more in that source as well. For the exporters, they saw record revenues. Some of that went back into oil and gas, but there was less of a focus on diversifying the energy mix. And this really informed our view around the possible implications of the Middle East conflict. Because in our view, this is, many of those same levers are likely to be pulled again. And that sort of provides a very powerful accelerant for changes that in many parts of the world are already underway. Now, we've talked about the Middle East, and oil naturally comes to mind when we mention the Middle East, and that's very much at the center of today's crisis. So that's where I wanted to say a few words next. These are the investment numbers. It's cumulative upstream oil investment looking back 5 years to 2021. And when you just look at those numbers for upstream oil investment, the importance of the Middle East doesn't really stand out. It's really North America that sees the most substantial amount of capital going to the oil sector. But when you look at the resources that are developed with those investment dollars, then you immediately see how most of those low-cost barrels are in the Middle East. And it's also strategically vital to have in mind that the route for market for most of those barrels is normally through the Strait of Hormuz. So what are the implications then for investment in the Middle East? And there's obviously a lot of uncertainties, but there's a few things that we can say. So we revised down our expectation for Middle East upstream investment this year. We now anticipate a small year-on-year decline. That That's in part related to the security risks from the conflict. But we also have to have in mind that revenues for some key Middle East producers are markedly lower this year. Not necessarily the ones that have those existing bypass routes from Saudi Arabia and UAE, but if you look at Iraq, you look at Kuwait, there's been a very significant hit to revenues and to government income, and that could potentially constrain funds available for capital investment in some cases. When we look at investments in the coming years, there's quite significant capital will also need to be used to repair damaged energy infrastructure. That's LNG, but also refineries, petchem facilities, some upstream assets as well. And then there's the strait itself. There's already a search underway, as the executive director mentioned, for new energy export routes that reduce today's excessive reliance on the strait. But those will take time, those will take capital, and risk perceptions around Middle East and Middle East investment change as a result. So for that region that's such an important mainstay of global supply, we're seeing significant changes in the investment picture. And it's not only about oil, a few words on gas as well, as the conflict, as we're all aware, has also halted LNG exports from the Gulf, mainly from Qatar. And this has come at a delicate moment for the gas industry. It's in the early years of a historic upswing in investment in LNG export facilities. You're looking at the early 20s, that steady stream of new project approvals. But then we had a record year for project approvals in 2025, 90% of those new projects coming from the United States, and that momentum has continued into the first quarter of this year. What does that mean for investment flows? Well, overall, if we look at all of the money going into gas supply investment, we're expecting that to reach around $330 billion this year. That's the highest level in 10 years. And one of the main reasons for that is that some $50 billion is going into investment in export terminals globally. That's more than double what we had in 2025. And that's despite the delay to some spending in the Middle East as project timelines have slipped for a couple of projects. So this upswing in LNG, if we broaden the horizon somewhat, that the availability of that new LNG coming to market has helped to weather the storm from the current conflict in gas markets. We've got new supplies coming in mainly from North America, and they're helping to offset the loss of cargoes from the Middle East. But the conflict also raises some important longer-term questions for these LNG investments, because it's affecting sentiment among those price-sensitive emerging and developing economies, particularly in Asia, that the gas industry is relying on as future consumers. Another effect of today's crisis could be to accelerate the move into what we're calling the age of electricity. So electricity has always been a big part of the investment picture. What you're looking at here is total investment spend back in 2015, but also highlighting then the share of investments going to electricity and electrification. And at the global level, it was already more than 1/3 of the total, even back in 2015. And for some economies, notably the big fuel importers, that indicator was already around half of the total. But since then, spending on electricity has been growing faster than other parts of the global energy economy, reflecting the fact that demand for electricity has been growing faster than for energy overall. So if we fast forward now to our expectations for 2026, striking to see that the share of investment going to electricity rises above, or it is to around 70% for China, 75% for the European Union. And in the case of China, bear in mind that those 10 years saw a massive overall expansion in China's energy spending. And that produces the picture that you have on the right-hand side of the screen, where more than half of the capital flows to all of the energy sector are now going to electricity and electrification. Now, electricity is not the only thing we need, and there are still some major gaps in that electricity spending. I'd highlight the country or the region, the continent at the bottom of the left-hand side in Africa, where we really need to see a pickup in spending on electricity infrastructure in many parts of the continent. But that shift towards investment in electricity is structural, and it's likely, in our view, to get additional momentum from today's crisis. When we get into some of the details on the electricity supply investment side, there are some interesting new trends to highlight. First, we're looking at renewables and nuclear, and we've had explosive growth in investment in recent years, and that was led by China. But the trend line in China, as you see on the screen, is now down. And that's in part a question of costs, and I'll come back to this in a second. But it's also because of a regulatory change in 2025 that exposed project developers to greater uncertainty about their future revenues, and that slowed the flow of new projects in China. We're also expecting a slight decline year on year in the United States. But renewables in particular, that's still where most of that capital going to new power generation is going. 70% of total power generation investments, and nuclear investments have grown steadily in recent years as well. The next highlight is something that the executive director mentioned. That's the money going to coal and gas-fired power. Now, China has traditionally been out in front, largely because of investments in coal. But you see that very sharp increase in the United States, primarily for new gas-fired power plants. And in our view, we will get that interesting crossover in 2026, where the United States becomes the predominant investor in that area. And a final reflection. Those of you who are regular readers of the World Energy Investment will recall that we've highlighted for a number of years that while investments in generation have been moving ahead very strongly, investments in infrastructure, in grids in particular, have been lagging behind. Well, that's really starting to change. Global spending on grids is expected at over $500 billion in 2026. That's up nearly 20% year on year, while spending on battery storage projects for the power sector is now well above $100 billion a year. That is welcome news. It does come with a caveat. Part of the reason why those investments are rising is because there is some tightness in supply chains for some key components, notably transformers and cables. I wanted to come back quickly to that rise in gas-fired power investment in the United States, because along with our assessment of investment spending, we also track the final investment decisions for new projects. That's the moment when the project sponsors decide to commit their capital. And decisions to move ahead with new gas-fired power plants have risen sharply since the start of 2025, and that was essentially down to one country, the United States. And there's a number of reasons for that, but a key one was demand for electricity from data centers. That applies both to projects connected to the grid, but also one trend that is noteworthy is the increasing amount of gas turbines that are being installed on site for data center use. I wanted to come back on the issue of costs, because when we look at investment trends, it's also essential to look at shifts in underlying costs. And I wanted to illustrate that with a few words on solar. So the average cost of installing 1 gigawatt of solar capacity has fallen dramatically over the past decade, from $3 billion in 2015 to something like $700 million last year. And that's had a huge impact on investment flows, because you generate this sort of virtuous circle of deployment, cost reductions, gives confidence to policymakers to step in with supportive policies, and that then increases deployment further. And since 2016, annual solar deployment has increased by a factor of 10. But the investment required to achieve that tenfold increase in capacity was only up by around 2.5 times. And those low costs for solar in combination with other technologies, notably batteries, that's proving very persuasive for investors and for countries, especially when fuel prices are as high as they are today. And as was mentioned, we're seeing one of the early impacts of the crisis is that very sharp pickup in solar panel imports in some of the countries that have been most affected by today's crisis in Africa and in Southeast Asia. A final reflection when we think about the implications of today's energy shock, it's worth thinking also about what it means for energy innovation. The energy innovation numbers, so the spending on R&D, isn't formally part of that 3.4 trillion, but it's a really important number for us to track, and it's an important part of our new report. If we think back to the 1970s, the oil shocks, that led to a massive upswing in support for energy R&D as countries looked for alternative ways to meet their energy needs. And that accelerated the deployment and scale up of many energy technologies that are really commonplace today. And you could easily imagine that today's energy shock could produce something similar, a new round of disruptive innovations, perhaps with a role for artificial intelligence in shortening innovation cycles. There's a lot of collaboration in this space, but there's also competition for technology leadership, and countries are taking different approaches. You see on the left-hand side of the screen that China is leading when it comes to public funding for energy research and developments, followed by the European Union. But the US is out in front when it comes to venture capital support. So a strong private investor appetite in the US for taking innovation risks. So whichever way you think about it, this also reinforces our central message. Today's Middle East conflict will leave a lasting impact on the future of the global energy sector. And with that, I'll pass it across to Jethro.
Thanks very much, Tim, to you for the presentation and to Dr. Birrell for the opening remarks. Obviously, a lot of insights, a lot of ground to cover with a report that covers investment across the entire energy sector. We now have time to take some questions from the journalists who are taking part. We invite you to send your questions through the Q&A function of the Zoom if you haven't done so already, and please mention your media outlet along with your question. We're just going to take a 2-minute break to give you a chance to enter your questions, and we'll be right back. Thank you. Hi everyone, welcome back. Thank you very much for the questions so far. We'll get through as many of them as we can in the time we have. So the first one comes from Junior Isles from the Energy Industry Times. He asks, what is your position or thinking on countries that are turning to coal or gas for power generation when keeping in mind the weather extremes we are seeing? And in this context more broadly, do you think the changes in energy investment that we're seeing as a result of the current crisis will have a net positive or net negative effect on efforts to combat climate change? And then a question from Tom Weingartner of Power News. He's asking about, I think in relation to perhaps the slide you showed, Tim, about solar, the cost of building 1 megawatt of new power capacity. How does the cost compare for wind, for solar, for gas, and coal? So those across those 4 different technologies, how do they compare? I guess what are we seeing in cost competitiveness trends across different technologies, and how that's affecting investment flows? So perhaps that first bunch of questions, Dr. Birrell, some thoughts on the different technologies that countries are turning to at the moment?
I mean, this is, of course, when the countries or governments make decisions, the fiscal policies, energy policies, their main preoccupation is today the energy security. In some countries, in some cases, or in many cases, I should say, when we talk about the power sector that our chief economist talk a lot, we see a major growth for renewables and also nuclear power. And as we said 3 years ago, that has been confirmed, nuclear is making a strong comeback. But in other countries, we also see that the coal is, especially in Asia, coal may be getting a push as a result of the energy security concerns. For the time being, it is too early to say what is the net emission effect here, and it can change from country to country. But as our report shows, we are seeing the growing interest in the last 3 months for renewables, nuclear power, coal, and in the transportation sector, electric cars. So too early to give a net effect answer to that. Mixed results from mixed countries coming through.
And then Tim, on the different technologies, the cost competitiveness.
Thanks, and thanks for the question. I think it's important to have in mind that the numbers that we present in the World Energy Investment are for capital costs. So they're the costs of building new energy infrastructure or the costs of a demand-side intervention and so on. And when we think about the competitiveness of different sources of power, those capital costs are only one part of the picture. And because you're dealing with very different types of investment. For example, in the case of wind and solar, the upfront costs are relatively high, but then the running costs are extremely low. Whereas with some of the other technologies that you mentioned, notably, for instance, gas-fired, the upfront costs are relatively modest, but then you have that ongoing, recurring need to buy fuel for that power generation plant. So when you're thinking about the competitiveness of different sources against each other, you need to factor in not just the capital costs, but also the broader costs and operating environment for those facilities. And there's another thing too, because even if you take that all into account and the financing costs as well, you end up with a metric that's often used called LCOE. But that doesn't fully reflect the value that different resources bring to the system, whether they are dispatchable, whether they are flexible. And so we take that all into account in the broader modeling work that we do at the International Energy Agency. But I think when it comes to the capital costs, I mean, those are available in the report. They also vary by by country. So I'd also refer you to some of the data that we make available with our annual World Energy Outlook, where we do provide capital cost estimates by region for different power sector technologies.
Thank you, Tim. Very helpful putting that in context. So we also have a question from Rainer Lutkerhus, who are, I think, from Energate Messenger, asking just about Europe in the context of the report. What does the report say about the EU? Are there any recommendations or takeaways for Europe in the current investment context? And then also a question about the crisis. You're talking about the crisis reshaping energy investment. What signs are we seeing of this so far? And there was an additional follow-up question on this from Junior Isles on how might trade routes be diversified. I think, Dr. Birrell, you talked about new pipelines, and Junior Isles also asked whether that could be pipelines could be something that could help Europe or other regions. So I guess Tim, a bit of Europe, like anything in particular that we're seeing here, and then the broader question on the what signs we're seeing of a response to the crisis so far for Dr. Birrell.
So I think when it comes to Europe, there's different ways of looking at the different energy shocks that we've had, but one of them is to think about 2022 as the wake-up call for Europe, and in some ways you could argue that the epicenter of the effects of today's energy crisis is more in Asia and parts of Africa and in parts of the Middle East as well. So in a sense, Europe, all the things that it's been thinking about and doing since 2022, provide a way to reduce the vulnerabilities associated with that fuel import dependency. And so, we come back to, the agenda of electrification, efficiency, as a way for Europe to manage some of those issues. But then I think the issue that the executive director mentioned comes into play very quickly as well. How do you ensure affordability through that process of change? How do you ensure that the economic incentives are aligned with those policy goals? Because at the moment, for various reasons, including energy taxation, sometimes there are barriers to making the switch to electricity, and those are very much part of the European policy discussion at the moment as well.
Thanks, Tim. Dr. Birrell, on the broader question, what signs are we seeing so far, and also potentially what in terms of countries responding, and also what might be the implications for energy trade routes?
I mean, what we see is that the countries are taking energy security now much more importantly than they were taking before. It's a top priority. For many countries, if there are three top priorities of energy, they are number one, energy security, number two, energy security, number three, energy security. And together with this, of course, affordability is important. But I should say the climate change is, for many countries, when we go to international for other discussions, climate change is sliding down in the priority agenda of the governments, despite the number of extreme weather events and their intensity is increasing. So the first signs is we see countries are now, when they thinking of building an energy trade and making an energy agreement with the importers or exporters, they look at, can I trust this country? If I have a long-term commitment for an energy partnership with this country, can it be in the next few years, can it be a geopolitical risk for my country? So this is becoming a major issue. The second issue, countries are trying to produce energy as much as possible domestically. whatever they have, which makes, of course, whether or not it makes economic sense or not. This is a very important point as well. And finally, of course, this change from country to country, but there is one thing, Jetro, which is common in most countries. Electrification is getting a big push because of as a response to this, but also as a response to growing electricity needs coming from the increasing number of air conditioners around the world, or as a result of the increasing number of electric cars. Only a few days ago, we published a report on electric cars. Says that about now 30% of all the new car sales are electric. It's a big number. And the third area is Tim just shown us perfectly, the data centers and artificial intelligence is a major driver. So electricity demand was already growing, electrification was already growing, but what we see in this report, this will get an additional boost as a result of the reaction to this crisis.
Thank you, Dr. Birrell. A good forward-looking note to end on. So all I can say is thank you very much. That's all we have time for today. We've covered as many questions in the time we have as we could. If any journalists have further questions that you'd like to ask about the report, we invite you to reach out to our press office and we'll get back to you as soon as we can. Many thanks to Dr. Birrell, to Tim and his team. Thank you to the journalists for the great questions, and thank you to everyone following this event online for your interest in the work of the IEA. The full World Energy Investment 2026 report is freely available on our website, so do please go and take a look if you haven't already. And with that, thank you and goodbye.